Welcome back. A lot to unpack on this week's episode, having the conversation around what's happening with these mortgage delinquencies. When we peel back the onion, what is the data telling us? Having a conversation about, most importantly, those CPI numbers that are going to be coming out next week, what we anticipate happening there, and more importantly, what we see happening right now in the GTA Toronto real estate market from the ground floor, having this conversation about what we see transpiring. So we welcome you back to the channel. It is Friday, Finance Fridays, and I am your host, Anthony, with In Touch Mortgage Solutions. And if you haven't subscribed to the channel, we do invite you to subscribe. Hit that notification bell so you get notified every time we do an update on the Bank of Canada or inflation or anything mortgage and real estate related. And also don't forget to leave your questions and comments in the comments section below, and we will do our best to answer those questions directly for you, or we'll be doing a future episode talking about all these questions. Now, let's get right into it, especially as we await the highly anticipated data. The CPI numbers are going to be coming out next week. And obviously, as we've seen in the US, those inflation numbers have ticked up a little bit, coming in slightly hotter than expected. They expected around 3.1 in the US. It came in at 3.2. I believe that story is probably going to be very close to what happens here in Canada. I think we're going to see a little bit of an uptick in those inflationary numbers here in Canada, especially with the mortgage interest cost, in light of obviously fuel prices going up a little bit from their lows, and more importantly, what's happening with these mortgages that are renewing as these higher interest costs play into the equation, and those higher rents, like we saw nationally. I think they're up around 10% from the previous year. So there's obviously a lot of pressures. We'll see exactly how that plays out, which, as we all know, is going to impact the Bank of Canada's next decision in April. So let's take a second and look at some of these mortgage delinquency products and what's happening with Equifax and some of our lenders, as there is a lot to unpack here. And as what they say, as the medicine is setting in, these higher interest rates are continuing to play out. We're starting to get those symptoms of those mortgage delinquencies tick up here in Canada. But I think once we take a moment, peel back the onion on this, pop the hood on these mortgage delinquency numbers, those headlines, yes, they did go up 135%. And although that number is very alarming, that is the rate of change in the delinquency numbers. So what does this mean, Anthony? What are you trying to say? Well, basically, if we think about it, from its lows where we saw the delinquency rates during the pandemic or even in previous years, to the point it is now, it has increased, yes, 135%. But let's break down that number and look at the Canadian landscape. According to the data, I think data coming out from Q3, December up into December 2023, there's around 5 million residential mortgages at play. Out of those 5 million mortgages, there's about 10,000 of them that are 90 days arrears. So when we talk about mortgage delinquency, we're generally referring to 90-day arrears, so mortgages that are 3 months past due. And ultimately, this could be a whole bunch of things. It could be lines of credits and mortgage products combined. But generally, the number, when you look at it between 5 million and 10,000, it is not that large. What do I mean by that? Well, if we think about where the delinquency rate was over the past little while, we are still at historic lows. We are still very much lower than where we were at certain points even during the early 2020s and prior to that. So, which tells a very interesting story, as many Canadians are resolute in paying their mortgages. And what we're finding, talking to Canadians every single day who have potential mortgages that are renewing or basically preparing for these mortgage renewals or for higher mortgage payments, is that they're stripping back or pulling back on other activities or other items. So what does that mean? A lot of Canadians that may have been accustomed to spending when interest rates were low, going more for dinner more often, or maybe traveling, they're starting to pull back a little bit on those extra spending. And this is something that's very important to understand. The Bank of Canada will be also looking at this, but we definitely have to understand that the pullback in the economy is also going to reduce growth in the economy, right? So if you are a Canadian that's not spending at your local, local community business, or you're not spending in the box stores, or you're not doing things that you normally would, well, that's going to pull back on the Canadian consumer, the growth in the economy. So that's something we have to look at, and that's what we've seen happening over, let's say, the last 6 quarters. We've seen significant pullbacks in that market, which could potentially open the door for the Bank of Canada to cut at some point. But remember, we're going to wait for that data to come out next week to see if those inflation numbers, if I'm correct, and we see that tick up a little bit, if that's going to open the door for the Bank of Canada to cut rates as early as June or July. I'm thinking that things are going to happen most likely in September. Let us know what you think in the comments sections below. Now, with all that mortgage delinquency talk, I think there's important conversations or some canary in the coal mine. And with our ear to the ground, you may or may not have heard, but obviously, yes, the banks posted their profits, their year-end earnings. They made their billions. They put away millions and billions of dollars as a whole for these potential bad loans, mortgages, lines of credits, car payments, so on and so forth. Now, that's important because ultimately the banks need to be protected. They need to protect their shareholders. They need to protect their book of business. But when you think about that, a lot of the banks, a lot of the lenders that we're talking to, they're still lending. Their lending criteria is expanding. Their appetite for risk has come back online, and that's something we've talked about. They are still lending. Now, ultimately, what we have to look at too is some of our alternative lenders, those lenders that are in the what we call alternate B space for clients that might be, for example, maybe they have a self-employed business. They don't generally qualify with a conventional bank in their model. Maybe they have some credit that is a little bit weaker. Maybe there's other situations that are popping up that are necessitating particular clients to work with these equity lenders. Now, one of these equity lenders that has come to the front was Equitable Bank. Equitable Bank had indicated that, yes, their mortgage delinquency numbers have picked up. And why is this a canary in the coal mine? Now, it may be a good news or bad news type of story, but for Equitable Bank, just to preface it, they're saying that, look, yes, our book of business is experiencing some difficulties. However, we think things are going to moderate in the coming months, years ahead, as all these mortgages fully renew. No different than the story happening right now where 50 to 60% of mortgages in Canada have yet to renew in 2024. And as we get closer or to the middle of 2024, those numbers will come down. More Canadians will renew into those higher rates, experiencing those financial difficulties and those pullbacks, right? This is important. But as I mentioned, a lot of Canadians are resolute in making their mortgage payments. On the equity side, we see some of these mortgages go into arrears. However, why it's important to understand on this front, why these lenders are sort of the indicator, at least for me, is because they've already renewed. A lot of these clients are taking shorter term products with these banks. They're not taking 5 or 3 year products on average. They're taking 1 to 2 year products in the anticipation that rates are going to level off or come down. So even from 2022, when we saw those rates jump up, a lot of clients that had mortgages in super low rates with these lenders have already renewed, and they're continuously renewing into those higher rates that are generally in and around the 6 to 7% mark. So this is something that we're seeing happening, and we're going to be paying close attention to it. But ultimately, having conversations extensively with our lenders, there are isolated incidents, there are certain scenarios, and a lot of these situations, from what we gather, could be based on Canadians that have businesses that are feeling those pressures as consumers pull back. Remember, so if these businesses are feeling these pressures, we're seeing it with the bankruptcies and insolvencies that are happening amongst businesses in Canada. And one thing I do want to point, and I want to get your thoughts on it, we've had this conversation on the side with some of our local realtors and other colleagues in the industry. There's a lot of businesses that were opened or initialized. Maybe you incorporated, you decided that you wanted to do a side hustle. Maybe that business wasn't too active, but you did have it. You were able to get the CEBA loan for businesses that granted you 40 to 60,000. We talked about this before. Now, as these loans were being made due in January, they haven't collected necessarily. Maybe you haven't paid it, and there are interest charges attached to it. And we're seeing that this potential for bankruptcies and insolvencies could be slightly related to these zombie corporations that took the money, folding business, and boom, they're done, right? So this is something that we do need to pay close attention to if there's a correlation. But so these are things that we're looking at as we start to get a better picture as we round out March and we wait for April. We're seeing a lot of things play out, a lot of sentiment coming from consumers, a lot of our clients who are reaching out, with those pre-approvals, looking at particular properties because we're finding out what's the driving force behind entering the market now. And to be honest, the data is all over the place, at least from our brokerage here. So what we're gathering from these clients is, yes, the Bank of Canada, many Canadians paying close attention to its next move. Will it cut in June? What will that do to the market? Will Canadians front load that market ahead of a cut because they think prices are going to escalate? A lot of clients are looking at that perspective. Many of them are saying, look, I need to move. A big portion of them are saying, I have a growing family. I need more space. It's a need versus a want in regards to the move. They just can't fit their family and lifestyle in a condo, a 1 or 2 bedroom condo. They need that next move. The other conversations that we're hearing from our clients, those are maybe have a better ear to the ground, like us, talking to developers, builders, and trades, is that they're not building these particular homes. They're not building single detached townhomes and semis. And understanding that when these new developments come to the market, right, when you're buying a pre-construction home, it's already spoken for, right? You go in, you put your deposit, you meet the deposit structure, and in 12, 18 months or whatever the closing date is, you will move into that property. But as the builders are seeing the writing on the wall, interest rates are still high, qualification is at very challenging times. We still have interest rates, in and around that 5 to 6% range, depending on the type of product. Yes, some interest rates on a 5-year product might be much lower, and we will be doing a rate announcement update at the end of the month going into April once we get some of that collective data. But ultimately, interest rates are moving. Canadians' affordability is at its all-time high. It's very difficult to afford, even to rent, as we saw all these rental prices that are obviously adding pressure into the market. I mean, thinking about, rents that are up 10%, you have a lot of individuals that are looking to purchase a home or maybe rent, and they're saying, well, this is super expensive. I can't even afford to rent in Toronto, GTA, but the builders aren't building. They're not bringing in that particular inventory just yet. There's less shovels in the ground, less permits being issued. And what are these permits being issued for? And yes, there might be some development on condos coming down the pipeline. But as we look at the pool of these new to Canada individuals, I think it's very important to understand a few things. And this is what we're seeing from our desk and right on the ground floor. A lot of these individuals that are coming here are culturally different than, let's say, some Canadians that have been here. And I don't mean this in a negative way. I mean this in a positive way. They're looking to grow a family. They're having more kids than the average. And that means they require more space. And you can't fit a family in a 600 square foot condo. You need more space. So this is why they're chasing these entry-level starter homes, is because that is the space that they need. And at certain price points, and if the home is well appointed and priced fairly, they are moving. We are seeing multiple offers. If you talk to someone who's actually in the process right now of going hunting for a home, they will tell you firsthand the challenges that they're facing again, right? This is not me saying, hey, we're trying to boast up the market and put fear into people's minds. That's not what we're doing. I don't need to do that. That's people that are out there shopping. They feel those pressures firsthand when they're out there trying to bid on the same home. Let's put a case in point. I've had clients that I've worked with that, we have to keep separation and confidentiality, but 2 sets of clients putting in the offer on the exact same home. I mean, when you start to see things like this play out, then you have to, scratch your head and think about what's going on. And a lot of our transactions, I would say 98% of them right now, and all those purchases, they are not in the condo space. They are in the single family, townhome, single family, 1-car garage, detached homes. And they're move-up buyers. They're buyers that have a substantial down payment. They've either sold their home, looking to move in. This is what we see happening as that inventory begins to dwindle and the supply is not coming to the market. So we have, yes, mortgage delinquencies ticking back up. You have to ask yourself the question, who is impacting, who's driving these delinquencies? What is the causality behind that? Obviously, we know interest rates, but there's other things that are behind the scenes. We've talked to some of these clients that might be facing financial difficulty. Thankfully, we haven't had any clients that have had to be put in this position. And we've had maybe one or two over the last year, and we've talked to them and said, look, if the writing's on the wall, something's happened with your business, rather than get into a 90-day arrears, start missing mortgage payments, reach out to your lender, have a conversation with them, right? Have that conversation with them. And depending on the type of lender, they might have some accommodations. We know from the Government of Canada's perspective, right from their website, that these programs are there. There's these news outlets, these coverage, or these particular situations where you can look online and say, look, if I'm going to miss my mortgage payment, I'm finding it financially difficult, what is an extreme circumstance? And these particular nuances are there, especially those who have maybe felt the financial pressures. And some clients that got into a home that we've talked to that went somewhere else, somebody told them what to do. They said, hey, go buy a house, we'll give you a private mortgage, or we'll get you a mortgage. They did some funky stuff. And now they're looking for remedies and they're trying to sell their home. So you have to understand there's a lot of things that have happened there. A lot of it could be self-inflicted pain. A lot of it could be misrepresentation or bad advice for them to get into the situation. And that's where who you work with does matter. But ultimately, let us know what you think is going to happen with these CPI numbers next week, especially with higher rents. More Canadians renewing their mortgages as those data points come out. Pullback in the economy could be positive, but ultimately, where do you think CPI, core inflation are? We'll be doing a full conversation next week on that, so make sure you're subscribed. But we'll leave the video here. Wishing everyone a wonderful Friday and an even better weekend ahead. Thanks for watching.